For this next video lecture, still under module number 2, so we will be discussing about the theoretical framework for auditing. Okay, so auditing operates within a theoretical framework which include assumptions that support many auditing concepts. So these are the following. First, it is believed or said that auditing function must operate on the assumption that the financial statements and financial data are verifiable. Okay, because in this case, in order for the practitioner or the auditor to conduct auditing, the subject matter should be verifiable and must have the characteristic of obtaining audit evidences to support the opinion. Okay, so that's why it must be verifiable. If that is not verifiable, meaning to say the auditor will have the limitation on the gathering of the evidence, so therefore there is no proof, okay, as to his opinion. So auditing cannot be conducted. Next, independence is required for the practitioner or the auditor when examining or auditing the financial statements. Why is independence required? Okay, first of all, being independent in the conduct of the audit means that the auditor should not be influenced, especially by the management, okay, in his evidence gathering, and most especially in his expression of opinion. So he must conduct the audit with independence, okay, to avoid bias and any risk, or to minimize the risk, okay, in auditing. So the purpose of being independent is, of course, mainly to express an opinion. So this is very important because, again, the users will rely on the report of the auditor in their decision making when looking or referring to the financial statements that are audited. So there must be no bias or any stain of influence on the part of the auditor. Okay, so therefore the auditor must act exclusively in the capacity of an auditor. Next, there should be no long-term conflict between the auditors and the management, because in this case, if there is a long-term conflict, it may create, again, bias on the part of the auditor. Okay, probably they will modify their opinion because there is conflict that exists for a long time. Okay, that is why actually when conducting an audit, it is advised that the entity should have a different auditor at least every 2 years, okay, to avoid any influence in good terms between the auditor and the management, or long-term conflict at the same time. However, short-term conflict may exist, so that is acceptable, especially on the application of the accounting principles and during the audit process. But it should be short-term only. For example, it should only last for that particular period where audit is conducted, and conflict will be resolved thereafter. Okay. Next, in the absence of a clear evidence, what was held true in the past for the enterprise under examination will not hold true in the future. So this is especially if the auditor is still the same last year and for the current year. So if the auditor audited the financial statement last year, and he still is the auditor for this year, so he should not consider that the financial statements this year will be the same as that of last year. So again, he should conduct the audit process objectively, independently, and gather sufficient and appropriate evidence to support his opinion for this current audit process. Okay, So next is the effective internal control structure will be able to reduce the probability of irregularities and misstatements in the financial statements. So internal controls are the measures that is implemented in an organization to minimize risk, errors, and fraud. Okay, so internal control are the rules and procedures that should be followed, okay, to avoid such negative practices that will result into fraud, error, and irregularities or even misstatement in the financial statements. So the auditor, in the conduct of audit, he would also evaluate the internal control if it is effective or not. So how do the auditor evaluate the internal control? This is by sampling and checking also if what is written in the rules are followed by the entity. Okay, so if that is effective, it will also follow that irregularities and misstatements in the preparation of our FS is reduced. So more likely, our financial statements will conform with the standards. But that should not be the sole basis of the auditor for his opinion. He would still consider gathering evidences. Okay? So next, an audit benefits the public because as we all know, since auditing is part of the assurance engagement, so it enhances the confidence of the intended users, okay, because there is the opinion of an independent practitioner. Okay, so next, what are the responsibilities of the management and those charged with governance on the audit of financial statements? So in your module, we defined the term management and those charged with governance. But of course, we all know that they are part of the top management who have the responsibility of overseeing the operations of the entity. Okay, so what are their responsibilities in the audit of financial statements? So these are the following. Okay, first, they are responsible for the preparation of financial statements, and their FS should be in accordance with an applicable financial reporting framework, or that is our PFRS. So they are not only responsible for the preparation of FS, they are also responsible in following the standards in preparing the FS. Okay, so next, the management and those charged with governance are also responsible to design, implement, and maintain internal control. Okay, internal controls which are relevant to the preparation of FS, that it should result from it being free from material misstatement, whether due to error or fraud. Okay, so the management should implement and establish internal control to minimize the risk of misstatement in their FS. Okay, the next responsibility is to provide the auditor with the access to all the information relevant in the preparation of their financial statements. This is, of course, for the purpose of gathering evidence to be evaluated for the expression of opinion. So if in the case where the auditor will have the limitation of the access to all information, so the auditor might consider modifying his opinion. Okay? Next responsibility is to provide the auditor with additional information that he may request from the management or to those charged with governance that will support his opinion. This must be relevant information related to the evaluation of the financial statements. Okay, so next, responsibility is for them to provide the auditor with unrestricted access to those within the entity who whom the auditor determines necessary to obtain audit evidence. So aside from the documents, the auditor must also be given access to interview and observe the processes, how the employees conduct their work, and even conduct interview from them, okay, to obtain audit evidence that are relevant to the audit process. Okay, so what are the applicable financial reporting framework that is used for the evaluation or the preparation of the financial statements? So here, the term applicable financial reporting framework means the financial reporting framework that is adopted by the management or those charged with governance in the preparation of their financial statements, which should be also acceptable in the view of the nature of the entity as well as the objective of the financial statements or what is required by law or regulation. So here, depending on what is applicable to the entity, and it must also be acceptable in the practice, so they can choose whatever applicable financial reporting that works for them or applicable for them in the preparation of their financial statements. Okay, so we have here first a general purpose framework. So this is a financial reporting framework designed to meet the common financial information needs of the users. So an example of a general purpose framework is our PFRS, because in this case, if we have a different purpose, okay, of using the financial statements, then the standards in PFRS is general for all. That is acceptable also for a wide users. Okay, so financial statements that are prepared under this framework, this is what we call the general purpose financial statements. So it can be given to the intended users with different objectives. Okay. On the other hand, we also have what we call the special purpose framework. So what is this special purpose framework? This is designed to meet the financial information needs of the specific users. So an example of this is using the cash basis of accounting. Okay, so you understand in your accounting that what is widely acceptable is accrual. Okay, however, there are certain users where they require cash basis of accounting. Okay, so the financial statements that are prepared under this special purpose framework, this is what we call the special purpose financial statement, because it will serve the needs or the specific needs of the specific users. It cannot be distributed to other users with the general objectives, okay, which was discussed in the previous slide. Okay, so either of these two financial reporting framework, this can be used by the management in the preparation of their financial statements, provided that this is their nature and is allowed by law. Okay, so another is we also have our fair presentation framework. Okay, so the term fair presentation framework, this is used to refer to a financial reporting framework that requires compliance with the requirements of the framework. And number one, it acknowledges explicitly or implicitly that to achieve the fair presentation of our FS, it may be necessary for the management to provide disclosure beyond those specifically required by the framework. Okay, when you say fair presentation, meaning the financial statements really was prepared in accordance with the standard And to support this claim, the management should attach in the financial statements the disclosure. What are the disclosures? So this can be found in the notes to financial statements, the supporting computation, the explanation of why did they use that particular framework, okay, how they did it come up with that amount, and so on. Okay, so that is for fair presentation. Okay, another is to acknowledge uh, explicitly that it may be necessary for the management to depart from a requirement or the framework to achieve fair presentation of the financial statements. So such departure are expected to be necessary only in extremely and rare circumstances. So in this case, there might be instance where in the preparation of the financial statements, the entity they deviate, meaning they did not follow the standard because based on their nature of business, if they will follow the standard, it will not make their financial statements fairly presented. That's why they deviated and used another standard. Okay, so in that case, the management should provide more details and disclosures related to this deviation for it to be considered still as fairly presented, although they did not conform or follow the standard. But this should be only in an extremely rare circumstances, okay, to be acceptable. Okay, what about for compliance framework? So under compliance framework, this term is used to refer to a financial reporting framework that requires compliance with the requirements, okay, of the framework, but it does not necessarily contain the acknowledgement that we have mentioned in the previous slide under the fair presentation framework. So in this case, compliance framework is just after the meeting of a certain requirement, okay, for it to be acceptable. Okay, so that's under compliance framework. Okay, so those are for the theoretical framework for auditing.